Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Tuesday, July 20th at 3 p.m. in London. Stock prices and bond yields both fell sharply yesterday. Big moves like this always demand an explanation, and a popular one appears to be that markets are worried that the Delta variant will cause the economy to weaken. We don't think this is quite right. And while in the very near term this distinction may not matter, in the long term it does. So why don't we think that a growth slowdown is the big story? Well, there are a few reasons. Strong retail sales last week means that our tracking numbers for U.S. growth have actually gone up. The news flow on infrastructure remains in line with our baseline that more stimulus is coming. And while the Delta variant is serious, all indications suggest that vaccines are highly effective at reducing hospitalizations, the main variable in determining whether broader activity needs to be restricted. Just as importantly, expressing worries over growth right now feels a bit like, in the words of my grandmother, closing the barn door after the cows have gotten out. U.S. Treasury yields have already fallen from about 1.75% to less than 1.2%. Smaller and more cyclical stocks have been underperforming for weeks. Markets, we're reminded once again, often move well ahead of the data or even concerns about the data. So what is going on? As my colleague Mike Wilson's been discussing on this program, while overall growth is still good, the rate of change has peaked. This so-called mid-cycle transition often leads to lower valuations and more defensive leadership, at least on a temporary basis. In light of this, they've upgraded consumer staples to overweight, and healthcare, another defensive sector, also remains an overweight. In our cross-asset work, we've been very focused on the similarities to early 2004, another mid-cycle period that saw choppy, sideways price action after a strong rally. That choppiness occurred even as the economy continued to get better. We think this remains a useful template, and would note that with yesterday's weakness, global equities are roughly unchanged since the middle of April of this year. Last but certainly not least is the idea of summer seasonality, the idea that markets tend to be somewhat weaker and often a bit more volatile between June and August. Meanwhile, otherwise small moves can also be exaggerated. In short, don't read recent weakness as a sign that the economy is about to materially weaken, but do brace yourself for more choppiness as this mid-cycle transition continues to play out. Thanks for listening. Subscribe to Thoughts on the Market on Apple Podcasts or wherever you listen, and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.